Hello, we are Twin Cities Alternative Finance, and we're here to represent the company and talk through an investment opportunity for Group 2, and you can see each of our names listed here in the slide. Just some general information about the investment opportunity itself that's been presented to us. Our cousin Robert has been presented with an opportunity to step into a trust equity position, and the opportunity has now been presented to us at Twin Cities Alternative Finance. And the opportunity is a development project that converts an existing parking lot into some housing and retail mixed-use space. Here at Twin Cities Alternative Finance, we primarily focus on buying and improving existing assets, but sometimes we will get into financing development transactions if it makes sense and is an attractive deal. We have a relatively short term to decide whether or not we want to accept this deal. We have just 10 days to decide. Some information is that the trust provides 20% equity for a 120,000 square foot building in downtown Minneapolis. And some starting information for our base case is we're making the assumption that the base rent is going to start at $30 a square foot. Vacancies are 70% for year 1, 30% for year 2, and 10% in year 3 and beyond. And there's currently an amortized loan that has been set up but is not currently signed.
And because of this relatively short time frame, it was critical to remodel a new pro forma based off of a previous transaction. So we've made these adjustments clear in our pro forma. So in scenario 1 here, some of the highlights are the square footage doubles from the previous 60,000 to 120,000. The marketing and releasing costs also double with that size doubling. But for our maintenance reserve, we don't completely double that because some of the maintenance reserve will be incurred regardless of if the building is 60,000 square feet or 120,000 square feet. Some more evaluation here. The construction will be quite a bit upfront, leaving us with a total build cost of $29 million, not quite 2 times the price of the other building because some of the infrastructure and site costs will stay the same, regardless of the size of the building. Our percent equity is 20%, while debt allows us to cover the remaining costs, sitting at about $23 million loan at an interest rate of 6.75%. So the internal rate of return for the leveraged buyout is about 9 percentage points higher than the internal rate of return on our unleveraged buyout. This is a positive leverage scenario, which uses debt to increase our IRR. And this ultimately puts us in a really good position with a relatively healthy IRR.
All right, upon further discussion, we decided to slightly alter our original pro forma, and we decided to be more optimistic about the market and more cautious about the build costs because of our collective background in construction. We think that rent can be increased to $34 per square foot, and more conservatively think that the maintenance reserve will need to double. We also believe that the cost of the build itself will need to double, slightly more expensive than what we had accounted for in our original pro forma. And we are slightly adjusting our vacancies. We believe that year 1 will have a 60% vacancy instead, and year 2 will be 40%. And then beyond that, we're going to stay at a steady 3% vacancy rate. And lastly, our cap rate is 6%. We're going to increase that slightly to 7%, showing some possibility for positive growth. All right, and then similar to our IRR for our pro forma 1, the leveraged buyout is 9% higher than the return on the unleveraged buyout. And this again is a positive leverage scenario where we could use debt to our advantage to increase our IRR.
Another part of our analysis, given that the investment opportunity is in the Minneapolis office market, we decided to do some research to get some updated information on what might make the market attractive. So we found out that it's relatively affordable compared to cities like New York, San Francisco, Miami. A lot of the bigger cities are far more expensive. So Minneapolis is a bit more of a middle market target, which is good for us. The typical average asking rents are about $27.48 per square foot, which is good for us because our investment seemed to have a bit higher returns than what the average currently is. There's an existing vacancy rate of 23.3%. And some of the largest office submarkets are the Minneapolis Business District, the St. Paul Business District, Southwest, West, and Northeast regions of Minneapolis. The suburban office submarkets are currently accounting for about 70% of new leasing volume in recent years, which is pretty good for us because we fall into this space, and we also fall into one of the larger office submarkets, which this project taking place in downtown Minneapolis. And lastly, just another consideration is the COVID impacts. They still remain uncertain, but of course, the obvious impact is that they've decreased occupancy in the buildings in general. So something to consider, and we want to make sure that we can be flexible or provide some sort of sensitivity analysis with the vacancy percentage and how that might affect our return on the project.
For this third scenario, we took the pro forma from scenario 2 and changed it to see what it might look like if we switch from a conventional 30-year loan to a LIBOR-based floating debt. LIBOR has recently been phased out, and there is now a forward rate in the US that is called SOFR. We found that the SOFR rate for April of 2023 was about 5.02%. We then took this and added it to the spread for US Bank and Carval, as this floating debt would likely use the same structure as seen in previous pro formas. We then calculated what the debt yield and debt service coverage ratio would look like with this floating debt structure. We got a debt yield of 3.16% and a debt service coverage ratio of 6.29. Since this was an interest-only loan, we paid down the loan in year 10. This left us with an internal rate of return of 26%. So is this a good deal? Through our research, we found that a cap rate of 5 to 10% is considered to be a good rate with moderate to low risk. The cap rate in our pro forma is set at 6%, but could increase to 7%, showing the possibility for positive growth. Furthermore, the IRR at the end of scenario 3 is showing 26%. We believe this internal rate of return is a good indicator of how profitable the investment might be in years to come. Finally, through our research of other properties in the area, we were able to see that our assumed rents per square foot, vacancy rates, and more seem to align with the asset classes market in the Minneapolis area. As far as risks go, the internal rate of return has a relatively high variability. This will be inclined by financing options that we choose to go with and could be affected by any changes in our estimates for expenses and construction. Furthermore, Twin Cities Alt Finance does not specialize in developmental financing. Now, this could be a concern. However, they do have some experience. They are, however, mostly focused on buying and improving asset classes. Finally, COVID-19 still presents a potential risk. There has been an increase in vacancy rates, and it is unclear how the market will adopt over a long term. But with that being said, we hope that this presentation provided adequate information regarding our options in this investment.